Payables and accrued liabilities, we are going to discuss first a detailed overview, then exit or disposal activities, and finally the asset retirement obligations. So let us start first with the overview. So when we say liabilities, what exactly do we mean? Liabilities are future obligations that a company has to pay in cash, sometimes in services, due to some past transactions. Let's say a company takes a loan. So it's a liability. This loan has to be paid sometimes in the future, right? Then liabilities can be split into two classifications: current liabilities and non-current liabilities. Current liabilities are those that the company expects to pay within 1 year or within its normal operating cycle, whichever is longer. Like let's say if 12 months is 1 year, of course, and the operating cycle size is 18 months. So any liability that is settled within 18 months, which is longer of these two numbers, that's the current liability. Or in case, let's say, normal 1 year and operating cycle is 9 months, let's say, in that case, any liability that is settled within 12 months, because remember, we need to take the longer, here 18, here 12. So any liability that is to be settled within 12 months, not 9 months, would be considered as a current liability. When we talk about the non-current liability, that is clearly the liability that will be settled after more than 12 months or operating cycle, whichever is longer. Clearly the liability that is settled over a longer period of time. Moreover, when we talk about current liabilities, our regular activities often result in current liabilities, like we take short-term loans from the banks, we take goods or services on credit. So current liabilities just emerge because of our normal course of business. A business may borrow from a bank to cover immediate expenses. So this could create a current liability. Next is valuation. How do we value liabilities, especially current liabilities? Current liabilities are recorded at the amount that will be paid to settle them. Like we have an account payable for $2,000. So we will record $2,000 on the balance sheet as that is the amount we are likely to pay. But if over time, if your current liabilities pile up to such an extent that they are much bigger than your current assets, that means you have issues. If you have more current liabilities than current assets, then you will struggle to pay your debts. So that clearly indicates a potential of a liquidity crisis. So that for this reason, investors, creditors, and of course the management, they all pay attention to size of your current liability, to the size of current liabilities, because that's the trouble if you are unable to pay. Like you go to the bank to seek for short-term funding, bank will look at the size of your current liabilities before it decides to give it a new loan to you or not. Because if your size of your current liability is significant, that means you have serious liquidity problems. Now let us discuss specifically some specific types of our liabilities. First, we have trade payables, trade accounts payables. They represent amounts owed by a business for goods, maybe for raw materials or supplies that a business has bought on credit. So they can be reported in two ways: gross and net. In gross method, purchases are recorded at the full invoice amount without deducting any potential discount. So like for example, if a business purchases goods worth $1,000 and the supplier has offered a 2% discount if the payment is made within a specified period of time. So in gross method, we would record our purchase for the full amount of $1,000 and payable is booked for full $1,000. And if payment is made within the time given by the supplier, then $20 discount is credited as an income. Then in net method, we have a different approach. In net method, the purchase are recorded at the amount net of discounts. Like in the previous example, if $1,000 is the amount of purchase and $20 is the discount, so we report $980 for the net purchase figure. Now let's say if we pay after the due date, maybe we pay after the discount period is over, because this 2% discount is only applicable if the payment is made within 10 days. What if we made payment on 30th or 14th day, after 10 days? In that case, we have to pay the full amount, $1,000 to our suppliers. So in that case, the $20 discount we have lost, we debit it to the purchase discount lost account, right? Debit 20. We debit account payable by 980 and we make the full payment of $1,000. That is in the net method. Let's take an example. An entity purchases $5,000 of inventory with terms 210 net 45 days near the end of year 1. The entity accounts for discounts using the gross method. Assume that the entity pays for the invoice after the year end, but prior to the expiration of the discount period. Now, what are we required to do? Prepare the journal entries when the trade payable is initially recorded in year 1 and when the account is paid in year 2. So, if you are using periodic inventory system, you debit purchases with full amount, credit accounts payable, and if you are using perpetual inventory system, you debit inventory, credit accounts payable with the full amount. The accounts payable balance is current as it will be paid within 45 days. Yes, as per the term of the purchase, the following entry would be recorded when the account is paid. We debit the account payable, gross amount. We pay 4,900 and then 1,000. This 100 represent the purchase discount, right? So if this is the gross method, we report the trade payables and purchases at the gross figure. Let's say if this question was asked regarding the net method, then in that case, you will record 4,900. And if payment is made within the discount period, you debit accounts payable 4,900, credit cash 4,900. And let's say if in this net method, you paid after the discount period, in that case, you debit your accounts payable, let me clean it up, 4,900, you debit 100 discount lost, and you credit your cash or bank with full 5,000. Trade notes payable. Let me explain this with the help of an example. Let's say you purchase a machinery for $10,000 on credit, and you, under a formal note, agreed to pay this amount in 6 months with 5% interest as well. So this transaction where you have given a formal note agreeing to pay the amount in 6 months with 5% interest, this is called trade note payable. So this transaction would be recorded as a trade note payable. Let me show you how. To purchase supplies, Dogs and Cats LLC borrows $50,000 from Credit Hall Bank on March 1st, signing a 12-month 5% note. Interest payments are due quarterly. So first transactions that you're going to record is the issuance of such a note. You debit cash or bank, credit trade note payable. The following entry records the issuance of notes, debit cash, credit notes payable. Now after a quarter, you have to pay interest as well. So the interest as per the question given is 5%. Quarterly would be 3 by 12. So if you simplify, 625. So debit interest expense, credit cash. At the end of the year, December, 1 month of interest must be accrued as the interest expense has been incurred but not yet paid in cash. So if you just go back, we should this on 1st of March. So from March 1st, March complete, April, May, till the end of May, 30th of May, you need to pay interest. Then from 1st of June to 31st of August, you make another payment of 625. The next from 1st of September to 30th of November, you make another quarterly interest payment of 625. Now we have full month of December from 1st of December to 31st of December. That's our reporting date. You have 1 month worth of interest due, accrued, which hasn't yet been paid by the end of the year. And that's what we're going to do. We're going to calculate the interest for 1 month, and we debit interest expense since it hasn't yet been paid. We credit interest payable, means it's an accrued interest to be reported at the end of the year. Now that brings us to the next topic, interest payable, which we just saw a little while ago. It means the interest that is accrued on the short term or even on the long term debt that is due but has not yet been paid. So we need to charge it as an expense. We debit the interest expense, credit interest payable. That's what you call interest payable or accrued interest. So this is applicable to any debt, current, non-current, with a stated rate of interest, such as loans or bonds where interest accumulates over time. And second part is accrual basis. Of course, if the interest is due but not yet paid by the end of the year, so any unpaid interest must be recorded as a payable, as we saw in the previous journal entry, because this is the interest that has been incurred, expense has been incurred, but it's unpaid. Current portion of long-term debt. What does it mean? It means that you have a long-term debt like You have a 10-year loan and you have to pay $10,000 in principal each year, right? So it means the loan size would be $100,000, which is split in 10 equal years, and you pay $10,000 every year. So this $10,000 which you pay every year, this is classified as a current liability every year, and the remaining part, let's say we're talking about the first year, so out of this 100,000, 10 is to be paid in the current year, remaining 90,000 in the next period. So that part which is due now is current, and the remaining part is called as the non-current liability. So current portions of long-term debt means part of the long-term debt that is due for repayment within the next year or next operating cycle, as we discussed a little while ago. So this amount which is due, this would be considered as a current liability. Current obligations expected to be refinanced. Let's say you have a $50,000 loan and it is due within a year. Maybe you have to pay it in the next 3 months, and you are at the balance sheet date. So that means it's due by maybe 20 or 31st of March, let's say. So before the financial statements are issued, you intend to refinance this into a long-term loan. So if you have the ability to prove that this arrangement has been made, then even this is the current liability on the balance sheet date. But if you have some evidence like an agreement with the banker that proves that this has been refinanced onto a long-term basis, then you can classify this as a non-current liability if you secure a refinancing agreement before the financial statements are issued. So there are certain conditions to be met here. This completing the refinancing before issuing financial statement, that's the first condition. And second is that you have a non-cancelable financing agreement from a lender with the funds to complete the refinancing, meaning the existence of a financing agreement from the banker, from the lender, whoever that be, having the financial resources. That institution has the resources to accomplish the refinancing. If these two conditions are met, then even a liability which is current of the nature can be and should be reported as a non-current liability. But the condition to be met, as I said, that financial statements haven't yet been issued. So such a liability can be classified and should be classified as a non-current liability. An important point here to note is that you need to disclose this in the financial statement. The amount reclassified, the details of the refinancing agreement, all must be fully disclosed in the financial statements or in the notes so that the users are aware of what has happened. And of course, the entry that you make to convert that current liability to non-current, you debit. The same example, we had that $50,000 liability coming due in 3 months. We debit short-term liability, credit long-term liability. So this is done even after the balance sheet date, but that is what is allowed by the standards, that even if it happened after the balance sheet date, but before the financial statements are issued, we can reclassify these liabilities into long-term basis. Next, we have accrued liabilities and expenses. Of course, this is something we have been doing from our very earlier accounting education in your graduation, or maybe in your master's. So accrued liabilities or expenses, these are expenses that have been incurred, but they have not yet been paid as of the balance sheet date. Like we have wages due at the end of the year, not yet paid, utilities due, not yet paid, rent due, not yet paid. So such expenses which are due but they haven't yet been paid, they are called accrued liabilities or accrued expenses. An employee works 5 days during the last week of the year and earns $12.50 a week. 3 of the days fall in the fiscal year 1 and 2 of the days fall in the fiscal year 2. So prepare the journal entry to record the accrued liability at the end of the fiscal year 1 and when employee is paid in fiscal year 2. See, the 3 days fall within the current year for which we have taken his services but we haven't yet paid. So for those 3 days we have to accrue the wages. So this is what we do. 1250 times 3 by 5. This is what is due, not yet paid at the end of the year. So you debit salaries and wages, 750, credit salaries, wages payable. Next week, when he gives the remaining 2 days service, 2 by 5 times 1250, that is the salaries and wages expense for the next 2 days. And this previous due was not paid at the end of the year 1, will be paid now. So this payable is debited. Expense for next 2 days is credited for the next year, and then full amount is paid 1250 for the full week, of which 3 fell in the last year and 2 days fell in the current period. So very straightforward. Just pause the video, redo the calculations, and it will make perfect sense. Next, we have taxes payable. Taxes payable include property taxes payable, sales taxes payable. Let us first discuss what is about property taxes payable. Normally, property taxes are often billed after the period they apply to. They are paid in arrears. So there are two methods of accruing property taxes. Let me just write this down so it makes perfect sense. First, accrual prior to invoice receipt. That means taxes are accrued before you actually receive the tax invoice, and then the taxes accrued are matched with the invoice from the tax department. And in the second, accrual upon invoice receipt means taxes are recorded as a payable when the tax invoice is received. So whichever of these two you use, either method is acceptable as long as it is applied consistently. And then we have sales taxes payable. Sales taxes basically are the amounts collected from customers when we sell goods or services, and we collect this tax on behalf of a taxing authority. I will explain with the help of an example later. So these taxes basically are our liability. We credit them to a payable account when we collect it, and we hold it with us till we remit it to the relevant authority. So sale taxes are not our expense because we are just collecting money for the taxing authority. We collect them and just simply pass through in our system. Like, take this example. A Jewelry Unlimited, a business, sells $10,000 bracelet and collects 7% sales tax. Prepare the journal entry for the sales. So the cash we collect, this $10,000 is our revenue. The $700 above we collect, this is the tax we hold for the tax authority. So we receive a total of $10,700. Our sales is $10,000. This $700 is the tax payable which we will remit to the tax authority later on. Next, we have employee related liabilities. And then we have unemployment taxes and employer's share of payroll taxes. Employers are responsible for accruing unemployment taxes and their share of payroll taxes, because there are two types of taxes related to payroll. For one, for which the employee are responsible, which we deduct on their behalf. Another part is what the employer is responsible. So we'll discuss them as we proceed through a journal entry. So these taxes are recorded as expense or liability in our books of account until they are paid. Then we have payroll deductions. Of course, these are like deduction related to Social Security, Medicare, income taxes. We hold these amounts with us till they are remitted to the appropriate authority. Here is an example. Hodge Corporation's weekly payroll totals $25,000. The entire balance is subject to FICA, that is Federal Insurance Contribution Act, and Medicare at the rate of 7.65%, and unemployment taxes 2%. The company withholds $3,000 for income taxes. Prepare the journal entries to record the weekly payroll and the employer's weekly tax expense. So salaries and wages expense debit $25,000. Of this, we have deducted from the employee salary 7.65% of FICA taxes payable. 7.65% of this amount is $19,13. Remaining $13,000 is withholding taxes payable, and that's what we pay net to our employees as their net takeaway salary. So these are the deductions made from the employee salary, so they are payable by them. Now, the part that is payable by the employer, an additional entry related to employer's tax expense must also be recorded. For this 2% unemployment taxes, this is payable by the employer, and 7.65% of this amount is also payable by the employer. So the entry that you're going to see is this liability now payable by the employer, 2% of this gross salary payable by the employer. So debit payroll taxes and credit these two liabilities and will be remitted when needed to be to the appropriate authority. Bonuses. Companies may pay bonuses to employees in addition to their regular salaries or wages. These bonuses, they are recorded as a part of salaries and wages expense. The problem with this is that normally bonuses are paid on net income. Let me tell you what is the issue. Let's say the company has generated a net income of $100,000, right? And 10% of this amount is to be paid as bonuses. So when you pay 10% of this amount, it's $10,000, which is to be reported as a part of salaries wage expense, 10,000 here. Then it's a critical issue. 10% of $100,000, 10,000 when goes and is charged as a as an expense in the income statement as salaries and wages, it will affect this number. So that is the twist. That is what makes calculations of bonuses complex, because bonuses are paid on net income, but they also reduce the net income as they are expensed. So this interdependence creates a challenge in determining the exact bonus amount, because as the net amount of your net income would be affected by the bonus figure. So that's what we're going to discuss in the next slide. X Corporation offers its sales vice president a bonus equal to 10% of net income after deducting taxes, but before deducting the bonus. Income without taxes or the bonus is $100,000 and the tax rate is 40%. Calculate the bonus, and that's the twist. Now this is the twist. Bonus is equal to 10% of net income, after bonus of course, and taxes are 40% of income after bonus. So this cyclical confusion has to be sorted out, and for this we use the basic algebra, the concept of simultaneous linear equations. So if you construct a linear equation for bonus, so bonus basically B, it's equal to 10% of our net income after taxes, that is 100,000 less taxes, call it T, and the taxes themselves is equal to 40% of the income after bonus, that is $100,000 minus bonus. So you're going to make two simultaneous linear equations and solve them simultaneously to find the bonus, because we are interested to find the bonus figure. So this way bonus is equal to 10% of $100,000, that will be 10,000 minus 0.1 T, and taxes is equal to 0.4 times 100,000, that is 40,000 minus 0.4 B. Since we need to find B, simply replace this value of T in this equation. Simple simultaneous equations. B is equal to $10,000 less 0.1. In place of T you write 40,000 less 0.4 B. That will be 4,000. That will be 0.04 B. And the final simplification will be B less 0.04 B is equal to $6,000, and finally the subject B would give you 6,000. 1 minus 0.04 is 0.96. 6250. That's it. Accrued vacations. Vacation accruals are recorded in the year. They are earned if these four conditions are met. First, obligation to compensate for services rendered means the employer's obligation to pay for these vacation time is based on the work the employee has already done, completed with the employer. Second, vest or accumulate, carry forward to subsequent period means the vacation benefits are guaranteed, are vested, regardless of the future service. So they are either paid now or they can be accumulated and be carried forward to the future accounting periods. Third, the payment probable means there is a high likelihood that the employer will pay for the accrued vacations. If these three conditions are met and not the fourth one, then it has to be disclosed in the notes to accounts. And if the fourth one, amount reasonably estimatable, means the amount of vacation liability can be reasonably estimated, in that case it is accrued as a liability. But if these three conditions are met, first three, in that case the employer should disclose this obligation in the financial statements instead of recording it as a full-fledged liability. Let's take an example. Taney Company began operations on January 1st, year 1. Taney's employees earn 4 weeks of paid vacations for each year of employment. Unused vacation time is carried forward and paid at the current salary in effect at the balance sheet date. So first three conditions are met. In year 1, James had taken no vacation. His salary as of December of year 1 was $300 per week. In year 2, his salary increased to $400 per week. Is it estimatable? Can we estimate the amount? Is the amount estimable? Yes. Calculate that means it will be accrued as a liability. C. Calculate the amount of Taney Company should carry as a liability for the James accumulated vacation time, and prepare the journal entries recorded at the end of year 1 and when James takes 4 weeks vacation in year 2. This is important. Employees earn 4 weeks of paid vacation for each year. So $300 per week. For 4 weeks, it's $1,200. So the trainee company would record the following journal entry at the end of year 1. Salaries and wages expense debit, salaries and wages payable credit, because it hasn't yet been paid. Now it further says what happens in year 2. Even if James' salary is raised in year 2, trainee company would still record the liability at the end of year 1 based on $300 per week salary, as the vacation was earned during the previous period. So when the 4 weeks of vacations are taken in the following year, the additional expense for increased wages would be recorded this way. We debit salaries wages payable. This is now reversed. Cash payment is made for the wages for the next week, and then total cash payment $1,600, of which $1,200 relates to vacation pay and related salary wages for the next week. So this is the total payment made. Self-insurance liabilities. Before we discuss liabilities, let us see what is self-insurance. Self-insurance is when a company chooses to bear certain risk directly instead of paying for third-party insurance. So by doing so, company is saving on insurance premium. You don't have to pay insurance premium anymore because you are managing the risk yourself. This is the first part. Since you are managing the risk yourself, what if the risks materialize? For that, you need to book some liability now. So how do we estimate the accruals of estimated losses? It has two components. First, any unpaid claims that have already been accumulated, let's say $10,000. And second, potential future claims based on the risks that they are self-insuring, mean we have to pay them off. So this is, let's say, $90,000. So the total liability you're going to report is $100,000. In certain cases, we may have to discount these liabilities, like if future payments can be reasonably estimated, maybe payable after 3 years, let's say. So if the amounts are reasonably estimatable, then we discount these future liabilities in the present terms. We calculate the present value of such liabilities. Similarly, that means we can then classify these liabilities into current and non-current. The current part means the payable within the upcoming years, and non-current that extends over longer periods. So self-insurance can be classified either as current or as a non-current, depending on when the payments are expected to be made. So let's do an example to help us understand the idea better. In preparing year-end financial statements, actuaries for Bridge or whatever incorporated determined that the company should record $350 for potential claims where the company chose to self-insure. In the past year, the company had to pay $145,000 in actual claims where they had no outstanding insurance coverage. Prepare the journal entries for both the claims accrual and the actual payout. Claims expense or provision for claims $350,000 debit. This is the amount connected here. Determine that the company should record this much for potential claims. So debit claim expense or provision for claims, credit unpaid claims liability, accrued liability or self-insurance. And when the actual payment is made, the company had to pay $145 in actual claims where they had no outstanding insurance coverage. So you paid out of the liability, you debit unpaid claims liability, credit cash. Simple as that. Exit and disposal activities means maybe sometimes business will have to do away with a certain segment that is not doing well, a certain operation, discontinued operation. I'm sure you would have read it elsewhere in your accounting studies. So these are the costs that we are liable to pay as a result of our decision to exit from certain process, operations, or disposal of activities that we have undertaken. So that's the main thrust of the topic. Exit and disposal costs, that's the main thing. These are the costs that arise when a company decides to exit a business segment or dispose of a certain asset. So there are certain key costs within this category. First is the involuntary employee termination benefits, means costs for benefits provided to employees, unfortunate ones, who are laid off as a part of this exit process. That part. Then costs to terminate a contract that is not a lease. These are the expenses incurred to terminate a contract other than lease. Like when you discontinue a certain segment, you may have to cancel many agreements with your customers, your suppliers. So there might be some cost to pay when you cancel such agreements and contracts. And finally, other costs associated with exit or disposal activities, including costs to consolidate facilities or relocate employees. So these are the expenses relating to consolidating facilities or relocating your employees elsewhere as a part of the exit or this disposal activity. Criteria for liability recognition. Certain conditions must be met in order for us to recognize this as a liability. First, obligating event occurred means a specific event must have occurred that creates the obligation for the entity. 2. Present obligation to transfer assets or provide services in the future means the event that has happened should lead to an immediate requirement for the company to either transfer assets or provide services in the future. 3. No discretion to avoid means you have no way to run away. Company must have no ability to avoid the obligation or very little ability to avoid this obligation, so you have to pay it. You have to transfer the assets, you have to pay for it. Now here is an important note. Let's say this is my company and this segment is being discontinued, right? So when this segment is discontinued, there are certain losses which we may have to bear on our regular ongoing operations. So any expected losses from our ongoing operations, this $2,000, let's say, this loss on our ongoing operation is the result of this disposal activity. So this loss cannot be accrued because this is part of our ongoing operations, right? So they are reported when they are actually incurred, not accrued when you are planning to dispose of the segment. So this probable loss, the key point to note, from our ongoing operations, it will only be recognized when it actually occurs. It is not accounted for at the time of commitment of the exit plans. That's the key point to be noted. Liability measurement means how do we measure liability related to these discontinued operations? First of all, the liability associated with the exit or these disposal plans should be measured at the fair value. First thing. Second, fair value adjustments. Yes, it is possible that there may be some changes required in the initial amount. So these adjustments can be made in the future where there such adjustments might be required. And third part is that these changes in fair value adjustments of this liability, it is treated prospectively. Remember, the change in estimate are accounted for prospectively. They are applied moving forward without altering our past financial statements. So these three key points must be noted. Your income statement will have two segments. One is the continuing operations and other will be the discontinued operations. So the key point is that if the costs relate to this exit or this disposal activity, the cost must be reported in the discontinued operations section of the income statement, right? All the costs associated with the discontinued operation, they must be reported under the discontinued operation. But if the costs are not related to discontinued operation, they will be reported under the income from continuing operations. So that is a straightforward concept, doesn't require more discussion. Then in disclosures, we are going to describe what activity is it, details of the exit or disposal activity, whatever you're closing, including the reasons why are we closing down, the reason behind the decision, and the estimated completion date. Then cost details for each major cost. It has two components. Number one, total expected cost, the cost incurred in the current period and the cost incurred in the prior period. So all costs to be reported here. And second, a reconciliation of liability that shows the liabilities opening balance, all the costs incurred, paid, settled with any other adjustments with the closing balance. So that's the second requirement under this category. Income statement line item, specify where you're going to report these costs. Then we have segment reporting. Each segment that you're going to close, disclose the total expected cost, the amount incurred during the period, and the cumulative cost along with any adjustments and reasons as a part of your income statement. And unrecognized liabilities means the costs that are not recognized just because we had no fair value. So if you don't report it on the face of balance sheet, report them in the notes, disclose the facts and the reasons. Here's an illustration to help you understand. An entity plans to close its facility in a particular location and determines that it no longer needs 100 employees who work at the facility. The entity notifies the employees that they will be terminated in 6 months. A termination benefit will be provided to each employee totaling 5,000. So there are 100 employees, so that means a total liability of $500,000. Right, on the date the employee stops working. On the communication date, the obligating event, you need to report a liability of $500,000, that is 5,000 times 100. Asset retirement obligations, or AROs. First of all, you need to have a very clear understanding. Certain assets under the law, they are required to be dismantled and decommissioned, like a nuclear power plant. So what is asset retirement obligation? An asset retirement obligation is a legal requirement to dismantle or to retire a tangible long-lived assets under the law due to some regulations. These AROs initially applied to nuclear decommissioning, but later on they were expanded to like oil, gas and mining. So don't just consider that just for nuclear power plants. It expands to oil, gas and mining industries as well. Now let's say we have a nuclear power plant that will last 15 years. And at that time we may have to pay $300 million as decommissioning cost. So in today's balance sheet now, we need to report the present value of this future cost. So that is basically the balance sheet requirement. AROs must be recognized using a balance sheet approach, right, where we report the present value of the future retirement cost, and these costs are shown as a liability in the balance sheet. ARO recognition criteria for recognizing ARO as an obligation. An asset retirement obligation qualifies as a liability if all these three conditions are met. First, duty or responsibility, means there is a duty or responsibility to retire the asset. Little or no discretion to avoid. You can't run away from it. The entity has no discretion to avoid the obligation, or very little obligation to avoid. So you have to do it one way or the other. And third, the obligating event has occurred, creating the retirement responsibility on you, maybe in the future, 15 or 30 years down the road, but you need to recognize it as a liability now. The key point or the key concern here is the uncertainty. There is uncertainty about the amount. So this uncertainty does not prevent you to recognize ARO. You have to. So instead of just avoiding it, uncertainty can be included into the calculation using some probabilistic technique like expected value analysis, expected cash flows. So in one way or the other, you have to bring in, whether it is uncertain or certain, so you have to bring in these future obligations for which you need to record a liability now. Like let's say after 15 years, we may have to pay $100,000, which is 50%. That is expected value approach. After 15 years, we may have to pay $150,000. That is 10% probable. And the amount could be $200,000. That is 40% probable. So you can take the weighted average of these numbers to find the estimate for the future liability. So this is the figure for expected cash flow, and you need to discount this number for 15 years to find its present value. Initial measurement or balance sheet approach. Let us take an example. Let us consider a company ABC. It operates an oil drilling site, and under the law, this oil rig or drilling site needs to be dismantled and cleaned up, and it will cost $100,000 at the end of the 10th year, let's say. Right, so let us assume, for simplicity reason, the discount rate is 5%. So now how are we going to record this in the books of accounts? Now we need to calculate the present value of this $100,000 payable at the end of the 10th year. What we will do, we'll simply take this cash flow, outflow basically, occurring at the end of the 10th year. We will divide it with the present value factor, that is 1 plus 5% raised to the power 10. That's how we discount future cash flows. So its present value would come out to be 61,391.33. So what you're going to do, you're going to make an entry. You're going to debit the asset retirement cost, which is 61,391 or maybe 61,392, and credit asset retirement obligation 61,392. Now this 61,392, it is the present value of the future obligation. As the time passes, year 1, 2, 3 and so on, year 10, this amount would grow. So each year the asset retirement obligation would accrue interest at the rate of 5%. So for this we make this journal entry, we debit accretion expense, credit asset retirement obligation, because the amount needs to grow at a certain rate. So for the first year, let's say, at the end of year 1, it's going to be 61,392, 5%, that's nearly 3070. So debit 3070, accretion expense goes to income statement, and your liability increases by 3070. So your obligation now is 61,392 plus 3070. Each year, this entry will keep on increasing this amount from 61 to 70, 80, 90, and when the obligation matures at the end of the 10 year, your asset retirement obligation will grow up fully to nearly $100,000. Since it's an asset recorded in the books of accounts, we need to depreciate it as well. So the value we use, 61,392, it needs to be, let's say on straight line basis, depreciated over 10 years. So the figure you get is 6139. So you debit depreciation expense and credit accumulated depreciation, and that goes on till 10 years. So during the period, we may come across a situation where we need to revise our estimate. Estimated cash flows for cleanup cost can change. They can go up or go down. Let's say if they are revised upward, let's say from $100,000 to $120,000, if this is the case, then this new liability needs to be recorded for. We will recalculate the present value using the current discount rate, right? So this is the way we're going to do it. Now, if the new present value is greater than the existing present value, so what you're going to do, add the difference to the asset retirement obligation and adjust the ARC accordingly. And it is possible that your revision might be downwards, right? Maybe it's $90,000. So use the historical discount rate to calculate the new PV. Clearly your PV will be revised, so reduce your asset retirement obligation by the difference between 90 versus what is appearing in the books, and that's how you're going to revise your estimates upwards and downwards. Please have a quick look. Upward revision to undiscounted cash flows are new liabilities. Use current discount rate, that is the rate currently prevalent, and downward revision requires the weighted average discount rate or the historical discount rate. Please note this is the key difference to be noted.